Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. Mastercard was founded in 1966 and was originally named Interbank. It was founded after Bank Americard, which is now Visa, had become profitable. Bank Americard was the first credit card, and initially it was a huge problem that cost the company a lot of money. However, after a couple years, Bank Americard became profitable, and a lot of other companies jumped in and created their own credit cards, and Mastercard was one of those companies. Mastercard specializes in financial services. Some of their notable products and services include debit, credit, and prepaid cards. Mastercard's operating segments include consumer credit, consumer debit and prepaid, and commercial credit and debit. In 2019, the company's largest segment was consumer debit and prepaid, which was responsible for 48% of payment volume by its customers. Consumer debit and prepaid has been growing the fastest for the company, with a 16% increase in payment volume between 2018 and 2019. Mastercard is currently the 11th largest company in America and is valued at $280 billion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. In 2014, Mastercard earned $3.10 per share. This value jumped up 8% in 2015 when they earned $3.35 per share. In 2016, Mastercard earned $3.69 per share, which was a 10% growth year over year. In 2017, Mastercard earned $3.65 per share, which was a 1% decrease year over year. In 2018, Mastercard's earnings jumped up 53% to $5.60 per share. And in 2019, Mastercard earned $7.94 per share, a 42% growth from 2018. This data indicates that Mastercard has grown its earnings on average 21% per year since 2014. Now that we've looked at the company's earnings, we will now talk about its price-to-earnings ratio, also known as PE ratio. PE ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low PE ratios are considered value stocks, while companies with higher PE ratios are considered growth stocks. PE ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a PE ratio under 15 means investors are somewhat pessimistic about a company's future, while a PE ratio above 30 indicates that investors are optimistic about the company's future. As of May 17th of 2020, Mastercard was trading at $278.94 per share. This represents a trailing 12-month price-to-earnings ratio of 35.69. This is significantly higher than the trailing 12-month price-to-earnings ratio of the Standard & Poor's 500, which at the time of this recording was 20.5. In this next slide, I will be talking about the company's price-to-earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's PE ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of May 17th of 2020, Mastercard was trading at $278.94 per share. This represents a trailing 12-month price-to-earnings growth ratio of 2.55. This indicates that Mastercard may be overvalued if this is the sole metric you use to value the company. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. As of May 17th of 2020, Mastercard currently offers a dividend yield of 0.57% as they pay 40 cents per share per quarter. Mastercard most recently raised their dividend in January of 2020 when they increased it from 33 cents per share per quarter to 40 cents per share per quarter. Mastercard over the past 5 years has increased their dividend by an average of 29% per year. Mastercard's dividend payout ratio is currently 35.7%, indicating that they have room to grow this dividend payment in the future. In this next slide, we will be going over the company's price-to-book ratio as well as its debt-to-equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price to book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt to equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt to equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt-to-equity ratio is not necessarily a bad thing. As of March 2020, Mastercard had a book value per share of $5.35. This represents a price-to-book ratio of 52.19. This is one of the higher price-to-book ratios of the companies that I have reviewed so far, with the only higher one being Amazon, I believe. As of March 2020, Mastercard had a debt-to-equity ratio of 2.3. This is also one of the higher debt-to-equity ratios of the companies that I have reviewed, and it indicates that Mastercard is financing a significant amount of their growth using debt. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you had bought Mastercard stock on May 1st of 2017, held it for 3 years, and reinvested all the dividends you received, you would have seen an average annual return of 35%. If you had bought Mastercard stock on May 1st of 2015, held it for 5 years, and reinvested all the dividends you received, you would have seen an average annual return of 25%. And if you had bought Mastercard stock 10 years ago on May 1st of 2010, held it for all 10 years, reinvesting all the dividends you received, you would have seen an average annual return of 29%. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. As a defensive investment, I gave Mastercard stock a B-. Mastercard is a company that does well when the economy is doing well and when people are spending a lot of money. That makes me worry a bit if we were to have a recession because Mastercard's earnings would drop. They also have a pretty high debt-to-equity ratio, which could cause some problems if their earnings were to drop by a significant amount. As a growth investment, I gave Mastercard stock an A. I love payment processing companies like Mastercard and Visa. I think as the world continues to use less and less paper money, these companies are just going to grow and grow and grow. As for Mastercard's value at its current price, I gave it a B+. I really like the growth I've seen in previous years, and I really like their business model. The only thing that scares me off just a little bit is their high price to earnings ratio. As an overall investment, I gave Mastercard stock an A-. I really like the future of payment processing companies, and I think Mastercard will continue to do well. Visa is Mastercard's main competition, and I really feel like both companies will continue to do well as the world continues to use less and less paper money. I think Mastercard is a good company to buy now and hold for 10 or 20 years, as I think that while it may look a bit expensive right now given its price to earnings ratio and price to earnings growth ratio, I wouldn't be surprised at all if its value was to double in the next 5 to 10 years. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching and take care.